So you're going into discrete fund management.
Well, remember we have a dividend value fund. It got Morningstar rank. I think it was the top fund in the last 2 quarters versus 1,300 other funds. So we have a SkyBridge dividend value fund that I'm sort of allowed to talk about.
But you're becoming less and less of a fund-of-funds manager.
Well, I mean, listen, I would say 97% of our assets are in the fund-of-funds space, but could we 3 years from now or 4 years from now have 10 to 25% of our assets away from our core product? I think so, because we've got very good culture at the firm. We have a very good distribution mechanism for raising assets, and I think we can attract core money managers to that platform that are doing very well for clients. So yes, I do think that will happen.
Where are you in assets right now?
A little over 10, probably 10.4 billion.
Where do you figure you'll be 5 years from now?
Well, again, I mean, knock on wood, we'll all be subjected to performance, but I don't think there's any reason why we couldn't double the size of the firm in 5 years. That's a 15% growth, so that's sort of like 7 or 8 from the market, and obviously growing externally, organically through good distribution and adding on products. I don't think there's any reason why we couldn't be a $20 billion firm in 5 years.
Where are you raising capital? You're raising it with H&A in China, or at least that's starting.
Where else? So we're raising money in Korea, raising money in China. We're raising money in Japan, outside of the United States. We have a person that works with us in the Middle East, and so we're in touch with a lot of money from the Middle East. I actually saw you in Riyadh, coincidentally, the day you were interviewing the Prince, and so we're going to be very active in the Middle East. But our core stuff is really here in the United States, where we have a great product for the mass affluent. Again, $25,000 to $50,000 minimums. Sustainable performance with a 90-day lockup, and so it's an ideal product for that market.
That's still your primary sales channel?
That's primary sales channel, and so there's probably 75,000 FAs in the United States across different platforms, you know, whether it's a Morgan Stanley or UBS, et cetera, that have our product offering that they're able to sell to their clients.
What are the economics of that relationship? For every dollar of revenue that you generate in fund-to-fund fees, you keep what, and the FA gets what?
Yeah, it's roughly 50-50.
50-50?
Yeah, roughly.
It's pretty good for the FA.
Yeah. I think it's good for everybody. I mean, again, it's fully disclosed, and if you look at our net number after our fees, it's a very attractive value add for the clients.
Anthony, a number of hedge funds and, well, let's just put it this way, a number of hedge fund strategies and a number of hedge fund managers have performed dismally in the post-crisis period. What do you like right now?
So, I mean, the sectors that I really like are, you know, the whole loan market, structured credit. There's a piece on our website on these TRUP securities, not Trump, but TRUP, T-R-U-P. They're trust preferred assets, where basically you can buy these bond-like products from community and small regional banks that are doing quite well. They have high interest rate returns, good absolute returns. It's a very sophisticated market, and so it's hard to decipher and understand. I think the thing I'm proudest about with SkyBridge, Troy Gajewski, Ray, Robert Duggan, Dan Burrell, our entire team, I'm obviously not going to mention everybody, but our entire team has done a very good job of constructing a portfolio that's not replicable in an ETF. And so I think it's important to distinguish, as everyone's plowing into ETFs, they should have something in their arsenal that's not ETF-like in case something goes awry in the ETF market. What
discarded strategies do you think are going to come back into favor?
Well, you know, when interest rates go up, you know, not to sound cliche, price discovery re-enters the market, and so the long-short managers, ironically, will start doing better. When interest rates are being forced down and you've got quantitative easing going on top of that.
The value guys got crushed.
It's just, it's very, very hard for people to be long something while their shorts are rising alongside of their longs, and so I think that's where the journalists have been critical of the long-short portfolios.
Investors too.
No question. If you step back and look at these indexes, it's 50-ish% long short. It's probably 15% macro. So 60% of the exposure is actually tied to the interest rate cycle. downward interest rates, those sectors don't do well. And SkyBridge, frankly, over the last 10 years have avoided those sectors and stayed more in the event-driven space, more in the what I would call structured credit space, which provided more absolute returns, greater certainty with lower volatility. But, listen, I think that the obituary that's been written about the hedge fund industry is overstated. It's like what Mark Twain said, the reports of my death have been greatly exaggerated. This industry's got $3 trillion of assets for a reason. They're super smart, sophisticated people in the industry. And with rate normalization, I predict the industry will have a renaissance.
Well, you had almost 800 hedge funds close last year. How many do you figure will close this year?
Not the big ones, though. Yeah, so there'll probably be another 800 that close this year. But what's happening is these are smaller funds on the margin, not doing super well. But if you look at the top 150 to 200 funds, if you will, the ones that Bloomberg frankly ranks, those businesses are doing quite well, and those businesses are transitioning from the founder model into something that's a little bit more institutional. And so I predict that will continue to happen.
What about the fallen angel managers? The Bill Ackmans, the David Einhorns, the John Paulsons. Mm-hmm. What happens to them?
Well, I mean, the good news for the three of them is that they've done very, very well in the space for a very long period of time. So I don't think anybody's having a charity outing for the three of them. If they decide to stay in the business, they're unbelievably smart people. And so each one of them will have a comeback that I think
really? You predict a comeback for Bill Ackman, you predict a comeback for David Einhorn and for John Paulson?
I do, because if they decide to stay in the business, of course,
which is managing money for third parties as opposed to just their own.
Exactly. I mean, of those three, I'm closest to John. And so what I would say about John is that he's a brilliant guy. He built a phenomenally institutionally powered up business. And so even though he's been on the wrong side of certain trades recently, there's no reason why, given what I know of him and the institutional quality of his business, that he can't have a resounding comeback. And so I'm rooting for that for him, because I think he's an awesome guy. I know Bill reasonably well. He's been to our conference. I used to cover Bill when I was at Goldman. This is about 15, maybe not longer, actually 20 plus years ago. And so I have a lot of respect for Bill. And if he stays in the game, he's a winner, and so he'll eventually start winning again. David, I've only met casually, so I can't really comment as much on David as the other two.
He's a value guy as much as anything.
Yeah, I mean, listen, I think here's what happens. You get on the wrong side of something, you're super high profile, the journalists put a spotlight on you, and